I'm Rick Bensignor. Today is Tuesday, September 29th, and welcome to this week's In the Know Trader show. Well, we start off as we record late Tuesday morning. The S&P is down about 10 points or so, having given up some early gains. 10-year yields are at 64 basis points. That's down about 2 basis points on the day. Oil is getting hit, down 3.75%, about a buck and a half. And nat gas is getting sharply hit, down 8%. Don't know what's fueling that move. It's probably something in weather related, as it so often is in natural gas. And gold's up about $16 on a weaker dollar today. Trading at December futures are at 1898 or so, just about on the high of the day as we speak. So let's take a look at what we're going to do today. First, we'll start off with our trader education portion. We're going to talk about relative strength and why you should care about relative strength. We'll do a market overview of the 11 macro sectors' relative performance like we do to start each week. And then today, we'll just simply look at the US dollar and take a look at what it's doing chart-wise and how it's affecting other markets. And then we'll also, in the sector analysis, we'll go through the 11 macro SPDR ETFs. We're about, 4 or 5 weeks away from elections. And I thought it would pay to, take a look at how the market's doing when you look at the 11 macro SPDR ETFs. And also, as we go through them, you'll also be able to get it. I think we'll probably, if we have time, we'll be able to look at them in relative strength terms too, and you'll see kind of how they're each doing. In fact, maybe we'll only look at them in relative terms. I'll have to decide as we get there. So we'll take a look at those today. So let's start off with why you should care about relative strength. And let me first define relative strength, and so that you're not confused with another term that sounds awfully similar, especially for those who look at charts, which is the relative strength index. The RSI is a technical indicator, and it has nothing at all to do with when we talk about relative strength in the market. So what is relative strength? Relative strength is the relationship of a stock to a broader grouping. Now, the broader grouping could, let's say, be the S&P. So we could look at, let's say, Apple divided by the S&P, and that'll give us a sense of how Apple is doing versus the broad market. So here, if we move to charts, and let me get to Apple. Here we go. So here's just a plain bar chart. It's a weekly bar chart of Apple. Obviously, it's very strong. It's pulled off from recent highs. But let's take a look. And of course, you can do this on StockCharts.com by doing AAPL colon SPX. So that will give you a left side divided by right side. So Apple divided by, let's say, the S&P. Here I'm my charting system, I'm going to do Apple divided by the S&P. And here's the relative performance chart. And the way you read this chart is similar to other charts, that if it's moving higher, it means that Apple, the numerator, is doing better than the denominator of that equation. So let's look in, since, let's say, early 2019, this has been straight up, except for the biggest correction now we've had this recently. And this down move over the last couple of months means that Apple was underperforming the S&P. So directionally, you look at this the same. And over time, clearly, if you go back here 10 years, we start this chart on the lower left part of our screen. It's currently right near as high as it's been, the upper right hand. So over time, Apple has outperformed the S&P. And that means that's a name that you'd be interested in, because you want to pick names to invest in that have a good chance of outperforming the broad market. If they don't outperform, there's no real vig in owning the name. There's no advantage to owning the name. You might as well just be in, let's say, the spiders themselves. So if you're going to play an individual stock, you generally do so with, well, certainly the intent is to make money, and it's to make more money than in a passive investment, which the passive investment, let's say, is the ETF that tracks a broad market. So you want to look at this as part of the equation of how you come and put a trade together, or an investment, either way, but more so for an investment. For the longer term, you're going to try to find names that outperform the broad index. And of course, this is what active money management is about. This is why mutual funds exist, because the portfolio manager at a mutual fund thinks that he or she is smart enough to pick a collection of names that will do better than the market itself. If they can't do better than the market, then you might as well just be in the market. Again, let's say an ETF like SPY or something similar, VOO or IWM or QQQ or anything that's tracking a broad index. If you can't pick winners, you might as well just get the return of the index over time. Generally, you'll do fairly well with that. If you want to actively manage your account, then the whole point of that is that you're going to do better than the index. And that's why looking at how a stock is doing relative to its benchmark is important. So if we look at Apple versus, let's say, the spiders, this is the chart. If we look, also you can think of terms of, let's look at Apple divided by, let's say, the XLK, the ETF that is in technology. So Apple's part of the technology group. And here it's the same type thing, but what we've done is change the benchmark. Instead of looking at Apple against the broad market, now we're getting a little more concentrated and looking at Apple versus technology. You can still see over time, it's a very decent outperformer. But from 2012 till 2018, it's kind of, it went through, 6-month periods to 2-year periods of underperformance, outperformance, underperformance, outperformance, underperformance, and now in the last year, it's had massive outperformance. So changing the benchmark, like we did here from the S&P to just technology names, it makes sense that Apple's not going to look as good as it had, because other tech names and technology itself has done very well over time. So now it has to stand out versus its peers within technology. And of course, if you wanted to take this a step further, you could look at what particular subgroup of technology Apple is in, and you could look at Apple versus that particular index, all with the purpose of trying to outperform a broad-based index. And again, if for those who don't want to put the time and effort into doing the homework necessary in order to come up with likelihood winners, relative winners over time, then you're fine just investing in the market in the broad sense. So whether it's spiders, QQQs, or any of the ETFs that you're interested in, you can do that. It's the difference really between active money management and passive money management, as well as is your goal to do better than the average return, or are you simply happy with the average return? Let's look at here. Here's FedEx, the stock, and you can see first the down move in the early part of 2020 and the massive move it's had since. And that's the look of the stock. But let's look at, let's say, FedEx divided by the S&P 500, and you can see you're much farther off of all-time highs in relative terms. This has still had a massive outperformance in the last 6 months. That's what this huge up move is here. So it's doing much better than the S&P has in the last 6 months. But if you go back from the beginning of 2018, that's when it's had its best all-time high in relative terms. So unless you bought it in the last 6 months, you've actually, if you bought it any time in the last 2 years except the last 6 months, this was not a particularly good name to be in, because it lost tremendous value versus the broad market. You would have been better taking the same dollars and putting them into the market itself than being in FedEx. It's only in the last 6 months that you were better off being in FedEx. versus the market. And this is why we look at this as part of the overall picture. And you can do the same thing. You could put FedEx versus, here, let's do it versus the industrial sector, because that's where FedEx is a part of. So similar looking chart, but in this case, it's done so well recently that it's near its all-time highs that we had seen in 2018. And then again, you could take this even one step further, and if there was a, you could put this into its subgroup within transportation stocks, but I'm not sure exactly what the subgroup is, but there is a subgroup that FedEx would be a part of, all within industrials. So you can take this to various limits of how much you want to whittle down to its subgroup. But in general, the reason why I wanted to spend some time today in looking at this is you want to be in names that have good looking charts in relative terms. So the next time you're thinking about buying a stock, don't just look and do the analysis on the stock itself. Look at it versus the S&P. If it's a technology name, look at it. You can look at it versus the S&P, or let's say the NASDAQ 100, which tends to be a tech-heavy benchmark index. So you can take your stock and let's say divide it by the QQQ. And then if you want to, you could take it, versus some peers, with the goal being that you're going to want to take the better looking charts and be long them as compared to not. And or if you're into pair trading, which takes a lot of market risk out of the picture, find stocks that against a peer and find the ones that have the best fundamentals and the best relative charts, so that you know which ones are acting better than others. And the ones that are acting better, you want to be long. And if you're going to pair them off with a short, then you take the ones that are underperforming as the short. Unless you think that rubber band is so far stretched that they're going to come back in. But in general, look to be long outperformers and look to be short underperformers. So here, just one thing quickly. Let's take a look at, here's the XLE versus the spiders. Okay, so this is the energy group versus the S&P. And in general, when you look at a chart that goes back 10 years and looks this horrific, there's not too often. I know last week I bought some Chevron. I told you guys about it, and I'm down a little bit on it, but I'm okay on it. I knew what I was doing, and I knew I was buying an underperformer, but I was buying it at a place that was comfortable doing it. But in general, you look at this and tells you, why would you want to put money into the energy space? In general, this is not a sector that you want to have exposure in. And we are, even as of right now, these are all-time lows. If I were to make this a monthly chart, you will see that we are on the lowest levels ever that energy, since the SPDR ETF started trading in 1998, this is the lowest ratio of XLE versus SPY that we've ever been on. So it is a horrific sector generally. I have very little exposure. In fact, Chevron is the only exposure I have in the energy space, and I've just put it on now. So I know I'm fighting trend, but I had reasons I felt like somewhere around $75 was not a bad place for a longer term investment to put some money in. And that's what I've done. So the stock's down $1 or $2, something like that, since I put it on, and that's okay. But in general, this tells me I don't want to be investing in the energy space until I have enough reason to think I truly have a bottom in place. And that's my talk today on relative strength. Okay, let's take a look. Let's go back to our slide here, and now let's take a look at the S&P 11 sectors. Before we do that, let me just remind you that, in fact, later this week is the turn of the month. We go from September to October. That means the newest issue of the 7-11 monthly SPDR sector ETF report comes out. That is exactly about what we're talking about. It is about investing in the best of the 11 macro sectors to outperform the S&P. and stay away from those that are hurting, dragging on the S&P, and that way you can outperform. That is a monthly piece. We've had tremendous response to it so far. If you want to get the newest issue, sign up now to get that new issue that will come out in just a couple days. We also have, of course, the weekly ETF Tactical Trader Report, which comes out Wednesday nights and gives you a review of what's going on in the markets, usually S&P, dollar, gold, bond market, and then a new ETF trading idea each week. And that's the Tactical Trader Report. And then, of course, my email for those of you who like to get in touch with me, it's rick@intheknowtrader.com. So here's the relative performance update week over week on the right-hand side versus what was last week's year-to-date on the left side. Bunch of sectors moved this week. Only 2 improved by 1% or more versus the S&P. That is consumer discretionary and technology, which are the bold blue and the pink ones. You can see, notice 4 sectors underperformed by more, and I starred the energy sector because it is now down over 51% relative to the S&P's return this year. And we just happened to look at the chart, so I started because it was, I knew it was a new low for the year, and a new low for the year also means it's a new low on an all-time basis. So energy is just, a huge dog. If you could have avoided exposure in energy this year, even now, it's only about 3% of the S&P, but if you didn't have exposure to the energy sector and to the financial sector, and you had reduced even in utilities and real estate, which are those are the big 4 losers this year, you would be outperforming the S&P. And, of course, the goal is to know that beforehand, and that's why we have this monthly report that comes out. Okay, now let's take a look at, let's go back to our charts, and let's go take a look at US dollar. So going back to 2011, the major secular uptrend line caught this year's low. We went right down to it. We had turned bearish the dollar at about 97 or so on the way down. We called for a move to 93 to 91.5. When it got there, not only did it get to the trend line, but it also did a setup weekly 9 count. We know that that's often at the turning point. So I had enough here to say cover shorts. You don't want to be short the dollar at this point, and it's bounced up. Notice here that it's getting close to kind of first level resistance, which is where it broke down from. We can even take a look at this on a daily chart, and here's that same line. So last week's high pretty much came right up to the line. Now, given how much time this spent, which was 2 full months creating the bottom here, my guess is that the quick move up and a little move back here is not enough to wash out shorts and people who need to have a position in the market, in the dollar market, but are not happy with a short down here. So this might very well still have some more room to go. But when I look at the big sense of what this is telling us, I come back and I look at the highs on the March spike in the dollar pretty much came close to where the early 2017, or actually very late 2016 highs were. That was the spike up when Trump actually won the election, and then it had been down all of the year that he started, his first year of the presidency, and it's made it way back up. So this is still in a bigger, kind of wider trading range when we look all the way back to 2015. If I put here, just kind of look at it in terms of that, you see it's a wider trading range, and we've come down towards, certainly less than halfway when we bounced recently. But I kind of think that 2021 could very well lead to a move that gets down here towards 87.5. So I'm generally probably going to be looking to sell rallies and just find the right time and place to do that. in a picture that I think probably still has some more downside to go, and that this trend line will get taken out at some point in 2021. That's my thought. So that's the dollar. And now let's take a look at the sectors. So we'll do the 11 sectors. And I think what we'll do is, just because I spoke about relative performance here, instead of looking at them just on their own, and we'll go alphabetically through the 11 ETFs, starting with XLB, which is materials. I'm going to switch this up a bit and make it XLB divided by SPY. Right, so here's the relative performance chart. Right, the black line is the actual relative performance. We've got a cloud chart on here. We've got a couple other models here, sequential or combo. So here we see that the longer-term trend over the last several years has been down for materials. It's had a good move up since April. Of course, the metals have done well. Chemicals have done well. And they had a recent spike up and pull back. So in general terms here, the highs here are very similar to prior highs. Let's put a trend line up, something just somewhere around that level, roughly 20%. So when the price of the XLB is 0.2 of the price of the spider, this thing has been running into trouble for a couple of years already. And we can put our trend line looking like this too. So far we're still within the context of the uptrend line off the March lows. And I would say until you get a real confirmation above this level or breakdown beneath, this stays in that range. I'd even say that materials could even get down to 0.18. I'd probably use 0.18, something like the double bottom here in the cloud going forward until year's end as being a real support level. So as long as it's above 0.18, then materials are something to consider as potential outperformers. For near term, still building a base off of what we've seen before. Next would be, so BC, XLC, Communication Services, divided by the S&P. Is going to have much shorter history because this was only made, right? The XLC only started trading, what was it, a year and a half ago or so, something like that. So there's a lot less to work with here, but and you can see over the course of 2018, we pretty much have also some type of triangular pattern here with roughly equal highs. So unless you make new highs, this is still within a consolidation phase. But I like the fact that it's kind of above this whole bottoming base. So it could pull back in here. To me, I'd look for, especially with, you look at the crossing here of, you have a negative MACD now, there's still some near-term downside momentum. So if this trend line breaks, I'd put some exposure on, but when it gets closer to, some of these old highs down in here, so let it pull back down in here, somewhere around 0.174. So again, 17 and a fraction percent, 17.4% of what the spider trades for before really putting on more exposure. We looked at energy already. So, this is that horrific chart of energy versus the S&P, just, big dog, and continues to be. So I'm going to certainly stay underweight that. And again, if I put on any exposure, that's my choice, but I'm going to be underweight. So I'm not going to have nearly as much. I would never have like 3% of my portfolio in energy because it's benchmark weight. And this is telling you don't want to be benchmark weight. Financials, also horrible. Last few years, we're on the lowest level. So despite the fact that everybody loves to be in financials, these are, this chart shows you it's a mess of a place to be in. Take a look at the lows in here, pretty much caught the highs here. So this is still a disaster, and financials just haven't bottomed yet. XLK divided by SPY. So here's technology, of course. This has had a massive uprun, continues to be the star. If anything, you start wondering about how much longer can valuations and things continue to be in the space. But as of right now, look, we made a recent low. If you don't even take out that low, nothing to consider about reducing exposure. But if the relative chart takes out that low, then you probably could lighten up a bit. It's not too often. Take a look in the past. It's not too often that when we get one of these spike lows, you end up taking it out. So I'd say if we take out this low, I'm probably going to sell some Qs and reduce my exposure. What do we have next? Industrials. So bearish chart, look at, here, let me take the cloud off. It's almost easy to see without the cloud. So in this case, take a look at something along that line, right? Lows, 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 near the lows. Tried to bounce there, boom, gone. So anything back towards 0.25, when industrials get 25% of the price of the S&P, expect some real resistance. They've done well recently. We have hit a 9 count. I don't know. This is, I'd have some exposure here. Certainly worth benchmark exposure. With the 9 count, I want to see if there's any follow through or pullback. But I would say industrials are worth, you know, if you're putting a portfolio together, they're probably worth some benchmark exposure. What's next? Staples. Staples are fairly neutral looking here. You can see it. Bounced early in the year when the market fell apart, gave all of its relative performance back. And you can see this is some of the work that we do in that monthly report. Now we go far more into depth and we give you actual asset allocation as far as how much to be in each sector and which sectors to avoid. It's a 35-page report. And again, it comes out monthly and it'll be coming out just a couple days as the new month begins. What's next? Real estate. Here's real estate over the last couple of years. So this also has limited history because it got spun out from financials back in 2016, but you're on virtually the worst levels that it's had since it became its own macro sector. You got a 9 count here. Again, 9's often called turn. 9 pretty darn close to the bottom for a year. 9 good for 6 months. This 9 was a high. Here we are now trying to bounce. So I'm not sure. I'd probably somewhere near or slightly beneath benchmark weight in this. Want to watch if we get a good solid MACD crossover. Then I'd probably want to be at least benchmark weight. XLU divided by SPY. Here's utilities, possible longer term bottoming, too early to tell. XLV versus SPY. I think this caught a lot of people by surprise how poorly healthcare's done. It gave back all the gains. Now, if you look at the start of the year, you're just a little, so on the year, it's only down a little bit, but it gave back a heck of a lot that started early, but you're still near longer term support. So you probably want benchmark weighting there. And lastly is consumer discretionary, which should look terrific. And it does, but I do know this is 13 years. So this also valuations and things are probably stretched. So I may very well not want to have anything more than, or maybe just a little bit more than benchmark weighted. And again, this is what we go much more deeply into in the report, so you know how to get the right allocations. That's it for this week. I hope you enjoyed the show. I'm Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.